Morning, Shane, and thanks very much for joining Blue Notes again on the morning of the interim result. It was a good result. We've spoken to Mike about the components of it, but one of the areas where it was ticked down a little bit was in the return on equity target, which was at 16%. Is that return on equity target still 16%, and is it achievable?
Absolutely, no, and I think Mike explained the value of having a 16% target. I mean, the real purpose when we set that target some time ago now was to reassure the market that we take the balance that we drive between growth and return very, very seriously, and that we're not prepared at ANZ to sacrifice return to drive growth, and we've got to get that balance right. So the 16 was important. I think Mike also mentioned the fact that there's no doubt that 16 target got a hell of a lot harder to achieve because of a couple of headwinds. One in particular was to do with just the fact that the Australian dollar is a lot lower than it was at the time. And while that's good for our shareholders overall, it means our earnings base is higher, it does tend to have a bit of a drag effect on ROE. That's probably made it about 50 points harder. That's one. And the second one, of course, the rules changed in terms of how much capital we have to hold, and therefore how much capital we need to generate that return on. That got a lot harder. But the point is, we're not walking away from the goal. We know it's achievable. We know it got harder, and we know we've got some work to do, but we're going to do it.
There's some key levers that you'll be looking at in that regard?
Well, I do a lot of staff town halls, and not necessarily all of our people understand the intricacies of ROE, but it's kind of a simple formula. It's more R and less E. So you need to make more return on smaller amount of equity, and we have programs around both, and so improving the balance of our business. And if you look at the strategy of ANZ, a lot of it is exactly that. It is about improving the quality of our earnings, more cash management earnings, more things like selling, helping customers hedge their foreign exchange earnings, more fee-based kind of businesses that are capital light and high return. On the other side is also being more capital efficient, making sure that when we do use our balance sheet for clients that we get paid fairly for that. And so there's a lot of rebalancing that has to happen over a period of time, and that's what we'll continue to do.
Another major element of the interim result was the FX effect. The Aussie dollar's collapsed, not good news for people using eBay buying stuff overseas, but it has been good news for the result.
Yeah, I mean, ANZ's a balanced business. Less than 60% of our earnings today come from Australia. That's down a little bit over the last few years, about 20% from New Zealand, which is quite strong because that business is doing very well. And then the balance comes from a range of currencies in Asia. That means that our shareholders benefit when the Australian dollar falls, the value of those offshore earnings goes up, and that's exactly what happened this time. It was quite a significant driver, and as I said, a very good thing for shareholders. And
is it directly related to the value of the Aussie dollar? If the Aussie dollar stays at this level, we would expect it not to change into the next result?
Yeah, it's quite a complex thing. I mean, yes, that is the single biggest driver, the Australian dollar, but there are other drivers in there as well, because it's also got to do with some of the Asian currencies, because we operate businesses right across the region. I mean, it's interesting today that 6% of our earnings actually come out of Chinese currency. So again, how that moves in relation to the US dollar and Australian dollar also starts to have an impact. But on balance, yes, it's the Australian dollar is primarily the largest driver of that impact. And just worth noting that it tends to boost it when the Australian dollar falls, it boosts our revenue numbers, but it also boosts our expenses, and actually it boosts our expenses slightly more than revenue, and that's a reflection of the fact that while we make a lot of revenue in other countries, we actually have quite a big expense base outside Australia and New Zealand because we operate a lot of these big operating hubs in places like Bangalore and Manila.
In the stock exchange announcement, you talk about capital generation. Obviously, capital generation is something that the world is focused on with banks at the moment. They want more and more capital. The regulators in Australia and elsewhere are talking about lifting that bar for capital. Are you comfortable that you can keep pace with those growing desires for more capital?
Yeah, well, we have two responsibilities in terms of when we think about capital. One is just what do we think the right amount of capital to have to run our business prudently. And we have a lot of models and thinking that goes into what we think the right number is, given the risks that we take, whether those risks are capital, credit risks, or whether they're operating risk or market risk or what have you. And then secondly, we have a responsibility to one of our most important stakeholders, our regulators, who set minimum standards and say, despite what you might think, we set some targets for you. And so we're very comfortable where we are in terms of having prudent amounts of capital. We said we wanted our common equity tier 1 ratio to be in the high 8s. That's where we are, and we've been maintaining that. We're comfortable. But there's no doubt that the regulatory side of the equation is changing, and it's been changing for years, and nobody expects that to stop. We don't know exactly where that's going to end up in terms of what those new targets are, And so it really comes down to an evaluation: does our business have the ability to self-generate sufficient capital to keep up? And we're confident that it does. And one of the really interesting things about ANZ, and I think almost unique amongst many of our peers, is we have quite a lot of options available to us in the form of many of the businesses that we own and operate that actually, for strategic reasons, not for capital reasons, but for strategic reasons, may no longer form a part or may no longer be as relevant in our business mix going forward. And so as we potentially dispose of those businesses, that has the added benefit of releasing capital. You saw in the last couple of days we've announced our intentions to dispose of the dealer finance business in Asanda. That, for example, that's a great example. I mean, the reason we're doing that is for strategic reasons, but actually that will have the benefit of releasing about 20 points of capital to the group and help us achieve those higher targets.
Credit quality is particularly benign, a little tick up in this current result in terms of provisions, but how are you seeing the general credit quality in the book?
No, the credit quality remains really sound actually. In fact, the provision charge was a slight tick down, and that's a trend that's been continuing for a period of time. The reality is that the economy here in Australia, in New Zealand and in most of Asia is actually quite benign in terms of risk. You know, our customers don't have lots of debt. Our customers are sitting on reasonable amounts of cash in their balance sheets, and they're operating prudently. So you've got this nice mixture where you've had prudent customers, and actually you've had prudent banks, because after the GFC, the banks all really tightened up in terms of the way they assess risk. And when those two things come together, we get the outcome that we have, which is a reasonably benign environment. There's nothing in the books today that say that's changing, although we're obviously always very alert to signals from the economy, and there is no doubt there's always patches of the economy, the resources sector or others, that are a bit troubled, and we have to keep a real close eye on that to see that those things don't get out of control.
There was quite a component of investment spending in this result. There's a sense that some of that is front-loading. You have to spend the money now and you'll see the benefits down the track. How far down the track with that sort of investment structure?
Yeah, look, it's our responsibility to make sure not only do we get the balance right between growth and return, but also the short term and the long term. And so, you know, at some level in a low growth environment, which we had, it'd be very easy for us to just kind of put the brakes on all spending and investment. But we recognise we have to create long-term value. And so where we see opportunities, where we can invest, whether that's hiring people, opening branches, launching new products, but get a return that is reasonably fast, and again, reasonably fast generally in our terms would be, we would see a payback in somewhere between 12 and 18 months, so we'd get our money back on those things. That's a responsible thing to do. The reason we target that kind of time period is because we accept that in the environment we're in, things can change very quickly, and so we don't want to be overly committed to long-term spending, but neither do we want to become too short-term focused.
Look, thanks again for your time and for speaking with Blue Notes.
Thanks a lot.